Hello, today is Tuesday, the 14th of October, 2008. This is Brian Shannon from alphatrends.net, and the market closed here. S&P 500, we saw a gap significantly higher here this morning, about 3% higher, and it was immediately met with some selling. Let's take a look at the 1 minute time frame. You can see that the highs of the day were made within the first minute. The market then found that selling that kept it below the daily VWAP pretty much all day. Made a very brief appearance above the daily VWAP here about midday, but that was just viewed as a chance for the sellers to take action, and really we saw a further breakdown in here. But we did get a little bit of recovery this afternoon. It only brought it right back up to the declining VWAP though, so really no progress was made in the afternoon. In fact, again, we finished with a 1.4% loss, and we remain in a bear market. Again, I want to point you to those charts of 1929, of 1987, and some of the other bear markets that I had shown on the blog, because you can't be complacent just because you get these big headline days. Bear market rallies tend to be very fast and very sharp, and then they start to fall upon the weight of more selling that comes in. So, volume was a little bit heavier today than it was yesterday, and we got up a little bit above that 10-day moving average, but not quite to the not on a closing basis. Yesterday I said maybe this rally, if it can continue, could head up towards 105, and that was what I was thinking was the high end. I think I said 103 and a half up to 105, and we saw it just around 105 level before again that gap failed basically. Bullishly, we are above the 5-day moving average, and that 5-day moving average is starting to flatten out a bit. I wouldn't, it's only very moderately bullish. Price action, obviously, on the daily time frame, weekly time frame, we still remain in a downtrend, but perhaps we can find a higher low. I think that a break below, not necessarily the 5-day moving average, I'll give it a little bit further room to let's say 95, a move back below 95. I think then it's possible we could see a retest of these lows or even lower lows. So we're not out of the woods by any measure. It remains a day trader's environment. As I said yesterday, I had sold all my long positions, and hopefully if you were still involved, you took advantage of that early strength and were able to get out of there. But these rallies in a downtrend typically do fail. Doesn't mean this one will, or it has failed yet, but when you look at all the potential resistance up above here on the Russell 2000, again, that 63, 64 level is the bigger level, but it's still pretty far away. When we look at a 30-minute time frame, let me just do this. Let me back off to about 15 days. That way we can get rid of that big gap. And now I've got to snap it back into the window here. My scaling's getting all screwed up, so here we go. We can take a look though and see this downtrend line still remains intact. Even though we're above that 5-day moving average, that 5-day moving average is still declining, and we came down and tested it in here today. So I think probably for this market, I would say a move back below about 52 and a half. Then you want to look at this very, very defensively and look for a potential for the market to drop back down towards the lows. Remember, we're also in earnings season right now. Earnings season is just beginning. Today after the close, we're getting earnings from Intel, and the calendar for earnings reports is very heavy. So if you're trading stocks, it adds just another dimension of risk to what we're doing here. And in a bear market, news and surprises tends to follow the direction of the trend. Back to the Russell though for a minute. This downtrend line is where we found some sellers. So maybe getting back above that trend line will bring the buyers back in. But again, the market is guilty till proven innocent. We want to be aware of any potentially bullish scenario, and I think breaking this trend line maybe sets the tone for a little bit further recovery. But on the bigger picture, this 63, 64 level is going to be a very important and I think very heavily defended level from the sellers. So there's really, it just remains a day trader's environment. Let's take a look at oil. The USO was down $2.48 or $3.66. Still remains in a vicious bear market, which of course as consumers we want to happen, and in oil. Guilty till proven innocent. On the weekly time frame, you can see that what some people were looking at as potential support in here from late last year and earlier this year. That's going to be important for the market to stay below 68.5. Getting back above there, maybe it starts to recover a little bit, but if it can stay weak, maybe we head back down towards $60 on the USO. So USO remains in a downtrend below a declining 5-day moving average, which it gapped right up to today and found sellers. Let's take a look now at the financials. The financials, they were up 5.5% today. So the financials have been the leaders in here. They're the ones that brought us down, obviously, with the whole mess. Now, is that mess going to transfer to the broader market through the earnings reports and the problems that they've caused there with a slowing economy? That remains to be seen. As far as the financials go, though, the 17 to 18 dollar level, basically where we are, is a pretty important area as far as where this market broke down from. We had prior support in this area, so this level, I think, getting back above 18 could help this market, but after a rally from 12.5 basically up to 18, it's hard to imagine it's going to get going from here. But we do on the 5-minute on the 30-minute time frame here, we do have a constructive pattern of higher highs and higher lows. The risks remain very high in here. If you bought down low at good prices and you're still holding, I would at least peel out of part of your position in here. That just seems to make good sense. But here's where we're finding that support at this prior level of resistance. So this level tomorrow and the next few days, I think near $16.70 or so, will be important as far as support. Breaking below that, then $15 level is the next area that potentially will find some buyers. The Nasdaq, what I said yesterday was I wouldn't be surprised if all these markets pulled back down towards their 5-day moving average. We see that on the 30-minute time frame, the trend line was broken yesterday. We saw the big gap up, and let's take a look at the 1-minute time frame in here, where again it got stuck below this declining daily VWAP, got above it very briefly in here, and from this failed move to hold on to it. So if you're buying, if you're using VWAP and figuring, well, I'll buy when it gets back above VWAP, risk management is job number one. If it makes a lower low right here, it was making these little higher lows, it worked away at that daily VWAP. Maybe it looked like the buyers were gaining back control, but this is what stops are for, and you should set that stop below this level right here, or whatever level it is that you think is the appropriate amount of risk that you're willing to tolerate. Maybe it would have been this low, or even this low right here. I prefer in a primary downtrend to keep my long stops extremely tight, and I give the benefit of the doubt to the sellers, not to the buyers in here. So this market remained below the daily VWAP for all but about 3 or 4 minutes in here today, and on the daily time frame you can see that this bounce is failing in here. This market was down 4.3%. It remains a very volatile market. The path of least resistance is lower on all but the actually on all time frames here. I mean, we've got lower highs, looking at a 5-minute time frame, lower highs and lower lows. 2-minute time frame, same thing. 1-minute time frame, same thing. So we remain in a bear market, and again, go study those historical charts to see prior bear market rallies and how long they lasted, how far they went, and take a look at how that relates to today's market, because it remains a very risky, very volatile bear market.